Hey everybody, Daniel Char here. In this video, I'm going to share with you the difference between a fixed mortgage versus a variable mortgage. Let's check it out.
You have not enough minerals.
So a lot of times I always get asked, what's a variable mortgage? What's a fixed mortgage? And then I also have people that say, I will never sign a variable because that's very high risk. Look at what happened to the States in 2008. All of those guys had variable mortgages. I just want to clear the air and just show you what the difference is between a variable and a fixed. And they're completely different in characteristics. So I'm just going to share with you the characteristics of a variable mortgage versus a fixed mortgage, and then we're going to go in one by one to see what the differences are. So for variable mortgages, they have a floating contract. So whatever you sign today is probably not what you're going to pay down in the future. It could change. It can go up or down. So whatever you sign today might not be what you're going to pay 2-3 years from now. Is this a good thing or a bad thing? It depends on what the prime rate is and how the economy is doing. At the same time, it's based on the prime rate, okay? It's based on the prime rate. Today at the filming of this video, prime is 2.45. And most banks will give you a discount off the prime rate. For instance, if you're signing a variable contract today, let's say prime is 2.45 and the bank will give you a 0.45 discount on prime. That means you're paying 2%. That's what you're paying today. If the rates drop, then your rate can drop. If the rates rise, then your rate will rise. Now, if the rates rise and you don't like that rise in rates, what you can do is you can convert it into a fixed contract. So a variable contract, a variable rate mortgage can turn into a fixed rate mortgage. And in regards to penalties, most people do sign a 5-year term for their mortgages, but believe it or not, over 70% of mortgages are broken at year 3, and over 80% of mortgages are broken at year 4. And why does this happen? Well, your family life status changes, probably the value of your home increased, you had a new member in your family, let's say you got married now, you had kids, so now you need to move. So a lot can change within 3 to 4 years, but most people do sign a 5-year deal, and if they were to break the mortgage at year 3, at year 4, or whenever, all they had to pay is 3 months of penalty, 3 months interest penalty. That's it. So that is what a variable mortgage is. In regards to a fixed mortgage, it's a locked-in contract. Whatever you negotiate for today is what you're going to pay for the next 5 years, or whatever your term is. So if you sign a 1-year fixed, 2-year fixed, 3-year, 4-year, 5-year fixed, it doesn't matter what it is, that rate is what you're going to pay. So even if the rates drop in the marketplace, you're still going to pay that higher rate. If the rates increase in the marketplace, you got the lower rate now. So whatever you sign for today is what you're going to pay for the rest of the term. Fixed rates are based on the lender's posted rate. So what do I mean by that? When you see banks advertise, hey, we got mortgages at 1.75, 1.99, that's not the real rates. Their real rates are probably around 4.79. At the filming of this video right now, it's 4.79 for most lenders. So what do I mean by that? Go on their website and go and look at 5-year fixed mortgage rates. You're probably gonna see 4.79. So if you walked into a bank or you walked into any lenders, most likely they're going to offer you that rate, 4.79. Once you pull your credit, you actually show commitment that you're serious about obtaining that mortgage, then what they're gonna do is they will give you a discount off the posted rate. And that is how you get that 1.99 rate. So it's off the posted rate, 4.79, they give you a discount, and now it's 1.99. So the real rate is not 1.99. The real rate was 4.79 discounted to 1.99. And why would they do that? I'm going to show you in a second. Fixed rate mortgages cannot convert to a variable mortgage. So if the rates rise or drop or whatever is happening in the marketplace, you're stuck, you're locked in. So let's say you sign a 3.99 deal today or 2.99 deal and the rates go to 1%. You're stuck, you're still paying that 2.99, you're still paying that 3.99. You cannot move. Whereas on a variable, if the rates go up, you can just lock it in, okay? Last component, very important component. So the penalty calculation is something called interest rate differential. Now, before I get into the penalties, I want to show you how the money supply works, how the money comes to you. So I have this little diagram over here. This is actually the Bank of Canada. This is the bank's bank. So when you hear on the news that the rates are going up or the rates are going down, that doesn't mean your rate is going up or down right now. It means that the cost of borrowing for your bank is going up or down. So what do I mean by that? Well, money comes from the Bank of Canada. And to put it, this is who you are. You are the borrower and you're borrowing money from your bank. And your bank's getting the money from the Bank of Canada. So the Bank of Canada is your bank's bank. And what they do is they lend money out. At the filming right now, it's at 0.25, a 0.25%. And what they do is they borrow money, your bank borrows money from the Bank of Canada to lend to you. And they might go off of their prime rate, and their prime rate right now for most banks is 2.45. That's the rate for their best customers. Now, what did I say earlier? On variable mortgages, you usually get a discount off prime. So if prime right now is 2.45, you might get a 45-point discount, and now your new rate is 2%. And that's how the bank makes money, because they're going to make something called a spread between the 2% and the 0.25% that cost them to borrow that money. And that difference goes to you. And this is what you are going to be paying as a customer. So that's how it works. Now, if you break a mortgage, you're on a variable, you're only going to pay 3 months penalty. However, on a fixed mortgage, it's off posted rate. Now, at the time of the filming right now, posted rate for most banks right now is 4.79. And how do you find that out? Just go on your bank's website, click on mortgages, and look at the mortgage rates. You're gonna see posted rates at a higher rate than what you're actually paying. Then you're gonna have another component where it says specials, 5-year specials. And that's when they're gonna post that 1.99% rate. So this difference between the posted rate and the rate that you're gonna pay, that is called the discount. Okay, so that's the discount. Why is this important? Well, if you're signing in a locked-in contract, and everybody knows that most people sign for 5 years, but most people, even after signing a 5-year contract, they break that contract at year 3 and year 4. Well, the bank's gotta make their money back, because when you break that contract, all that revenue is gone. So how do you calculate the revenue? Well, they're gonna take the posted rate at the time of the breakage, and then they're going to calculate how much money you owe and how much time is left on the contract. So let's say if you signed a 5-year deal, you broke the deal at year 3, you still have 2 more years to go. And if you owe $300,000, they're just gonna calculate that compared to the posted rate, because at the end of the day, whatever discount they gave you in the beginning, they want that discount back. So just to recap, variable mortgages are floating rate contracts. It can go up, it can go down depending on prime rates, and you can find your prime rate for your banks on their website. Every bank has a different prime rate, and usually when you get a variable rate, they give you a discount off prime. So if your prime rate for the bank is 2.45, they might give you a 0.45 discount, and now you're paying 2%. That's how they got a 2% mortgage. It's not 2% right off the bat, it's a discount off prime. A variable mortgage can convert into a fixed contract. So if the rates are starting to rise and you get scared and you think it's gonna keep going up, you can convert that into a fixed contract, and it's a brand new deal, you're locked in. And if you were to break the contract, you only have to pay 3 months penalty. One more thing I want to actually add in is that you never lose the discount off prime. So for example, if the Bank of Canada was to slash this 0.25% and they put the rates at 0%, most likely your bank will drop their prime rate as well. Whatever discount you signed up at the beginning of your mortgage stays with you. So if you got a 0.45% discount, you're gonna get a new 0.45% discount on the new prime rate. If you got a 0.70% discount, whatever the new prime rate is, you're gonna keep that 0.70 discount. You never lose the discount when you're in a variable mortgage. On a fixed contract, it's a locked-in contract. So whatever you sign for that term, it is what it is. If the rates go up, if the rates go down, you're stuck paying that same rate, whether it's a good thing or a bad thing. The rates are based off the lender's posted rate. So even though you might be paying 1.99 or 1.97, that's not the real rate. The real rate was their posted rate, and you got a discount off their posted rate. You can find out what the posted rate is on your bank's website. Now, fixed rate mortgages cannot convert to a variable mortgage. So if you're paying, I don't know, 2.49 right now, and then the rates drop, let's say Bank of Canada slashed this rate and it goes to 0 over here, and everybody's dropping rates left, right, and center, it doesn't matter. You're stuck paying that 2.49. So you cannot convert this to a variable. A variable can convert to fixed, a fixed cannot convert to a variable. And if you were to break this mortgage before the term ends, you would be charged something called interest rate differential, not a 3 months penalty. Interest rate differential means whatever discount that the bank gave you in the beginning of the contract, that they want that discount back. So what they'll do is calculate the posted rate, compare it with how much money you have outstanding as a balance and how much time you have left to the actual contract that you initially signed. That's how they're gonna come up with the interest rate differential. All right, guys, I hope you enjoyed this video in regards to the difference between a fixed rate mortgage and a variable rate mortgage. If you have any questions, please put it in the comment section. Please like, comment, subscribe, and I'll see you in the next video. Take care.
You have not enough minerals.